review your financials in detail and provide you with a custom strategy to buy the home of your dreams with the best interest rate possible. When it comes to the exciting journey of buying a home, understanding the factors that affect your mortgage interest rate can help make you informed decisions when buying a home. From economic conditions and market trends to credit scores and loan duration, a lot is taken into account before arriving at your final rate. Let's break down each of the above factors on how it can impact your interest. Loan term. The loan term refers to the length of time you have to repay the loan. Shorter loan terms, like 15 years, typically come with lower interest rates compared to longer terms, 30 years, because lenders perceive shorter terms as less risky and they'll generally offer better rates to borrowers who can repay their loans more quickly. Next, down payment. The down payment is the initial upfront payment you make towards the purchase of your home. A larger down payment generally leads to a lower interest rate because a larger down payment reduces the lender's risk. For example, if you provide a 5% down payment, the lender needs to cover the other 95% of the purchase price. On the other hand, with a 20% down payment, the lender only needs to cover the 80% of the purchase price. As you invest more of your own money in the property, you make it less likely to default on the loan. Credit score. Your credit score is a significant factor in determining your interest rate. A higher credit score usually results in a lower interest rate. Lenders use credit score to assess your credit worthiness and determine the risk associated with lending to you. Borrowers with higher credit scores are seen as more financially responsible and therefore offered more favorable rates. Loan amount. The loan amount is the total amount you are borrowing to purchase the home. In general, larger loan amounts may lead to slightly higher interest rates. This is because larger loans represent higher risk for lenders, so they might adjust the interest rate accordingly to mitigate that risk. Location. The location of the home can impact your interest rate. Lenders consider factors like local economy, housing market conditions, and property values in the area. Some areas have more stable markets, leading to better rates, while others might be riskier, resulting in slightly higher rates. Housing supply. The supply and demand for homes in a particular area can also influence your interest rate. In areas where there's a shortage of available homes, demand might drive up prices, potentially affecting interest rates. If there's an oversupply of homes, it could lead to more competitive pricing and potentially lower rates. It's important to note that these factors are often interconnected. For instance, a higher credit score could allow you to qualify for a larger loan amount, or a larger down payment might be easier with a shorter term. When preparing to buy a home, it's a good idea to consider these factors holistically and work to improve them as much as possible to secure the best possible interest rate on your mortgage. Take each of these with a grain of salt, as each home buyer is completely unique. Be sure to connect with a lender, as they will be able to review your financials in detail and provide you with a custom strategy to buy the home of your dreams with the best interest rate possible. Be sure to like and subscribe for more real estate content.